That risk management guide that I posted on the group. Okay, so we just go through it. I'll just go through it here. Explain one or two things. So the market will always be probabilistic. Hence, rules keep the trader amid uncertainty because we are never certain of the kind of results you are going to get. You understand? So we have to keep our rules in place. Rules that are going to help us when we lose. You get so that when those downtime comes, we are not going to lose too much. And we are still going to be in business, right? So that's why we need these rules. That's why we need these rules. All right. So there will be just a few pairs to trade to limit risk exposure. So, and it listed that I will look for opportunities in these markets in order of priority. Euro USD, CAD JPY, gold, and BTC. All right. So it's actually important that you actually choose a group of currency pairs. The collection is small collection that you trade most of the time. That's all you trade, right? So it's not like a rule set in stone. You can still trade others, but it's important that you just choose just those few. Choosing a few currency pairs will help you to master price action faster, right? Because you're looking at the same thing every day, and as I look at the same thing every day, you're going to be seeing patterns repeat. You get, and as you see them repeat over and over and over again, you get better with it. So, as a beginner, you can just start by scalping. The lower time frames to give you like opportunity to see the setup over and over and over again. You get, because you're just trading over a short period of time. Yeah, so it's important to choose a few. So you can start by choosing maybe two majors and two crosses. You get, a major is any currency pair that has USD in it. So your GBP USD, Euro USD, USD JPY, USD CAD, etc. All those are majors. Why you can choose one cross. Crosses, all these crosses are currency pairs that don't have USD in them, like GBP, Euro GBP, GBP CAD, other pairs like that. These are crosses. You guess you can choose two majors, two crosses, and maybe gold, something like that. You get. So but if you have a small account, don't choose gold though. You have a small $100 account, don't go and be trading gold. Except if your stop loss is very, very tight. You get. Okay, so that is all for this. You need to choose a few pairs. So this person is choosing one major, one cross, gold, and BTC. With sometimes, in rare cases, he also trades Ripple to the USD. Okay, let's move on. So category 1, 8 figures, $1 million to like $9 million. So risk per trade is 0.25 to 1% risk per trade. So in Nigeria right now, this figure is a little bit big. Yes. So you can maybe, since you are going to be trading or likely going to be trading smaller money, you can increase your risk since the money is small. And if you lose some of it, don't be that painful. You get. But if you are trading a big amount like this, you can like 1% risk is the highest you should ever take. 1% risk. So that means if you are trading a $1 billion, 1% risk of that would be $10,000, right? $10,000 loss on that trade. Okay, so you should absolutely limit your risk to be very small. So if you are trading like, let's say, a smaller account, or this $100 area, $100 above, you get. So you should be trading maybe highest of 2% risk or 3% risk per trade. 3% risk per trade, highest, maximum, you get. So since your account is small, you can increase your risk a little bit. Well, it's better to start with this. It's just going to help you be consistent in the long run. So max trade loss for a day is 2%. So if you lose 2% in one single day, you just stop trading. And max trade loss for a week is 4.5%. So if you lose 4.5% in 1 week, you stop no matter which day of the week that is. So at any moment, if the percentage is exceeded, that is all for the week. It means I can lose I can only lose 2% max in a day and 4% max in a week. So if there are losses consecutively for 2 weeks, which starts 9%, we say it's 4% max loss per week. So if we have 2 weeks that we lost this 4.5% consecutively, if we lost 9% risk in total, we'll take a week off to reassess the market and come back later. So just take a week off, cool off. read here and read a few things, check how the market is going. So you can get a new perspective on the market direction. If you use for 2 weeks collectively, likely that you are holding an old market direction in your mind, and that's what you're not trying to trade. Instead of trading in the market actual direction. So if you take a break, you can actually see the change in market direction you get. So trade objective 3 to 5 hours at least. So that means once we get 3 to 5 times our risk on that trade. So let's say our risk is $10. Once we get $50 profits or $30 profit, we should close 80% of our position. Close 80% of the position if your TP is still far. Right? So closing 80% of your position means that, for example, if you open one lot size, 80% of your position is 0.8 lot size. Get so that's 80% of it. So once you achieve 3 to 5 times your risk on that trade, you should close 80% of your position. Then you cannot leave the rest to run. But if your TP is not that far, you can just close the whole trade. 3 to 5 hours is very, very good. It's very, very good and sustainable. You get so no SL shifted after entering a trade. Either it takes me out or I close the trade myself, but no shifting of SL of stop loss. So this will mean that every trade must be carefully planned and was it carefully planned before entering at all. So this is important because sometimes you'll be like, this my stop loss is actually wrong, and then you now shift it, and keep shifting it, right? And that's the actual reason putting in big loss at the end. So do not shift your SL. Do not shift your SL. Okay, there's actually two sides to this sword. So you can actually shift your SL, but do not shift your SL to make it bigger, right? So if you have planned that your stop loss is going to be 15 pips, never shift it to maybe 20 pips or 30 pips or 25 pips. Never ever shift it to be bigger. The only time you can shift it is when the market has gone in your favor and then you want to remove your risk. So you cannot move your stop loss to break even, which means that you move your stop loss to slight profits. So never increase your stop loss to increase your risk. Always, the only thing you can shift your stop loss is if you are reducing your risk, not increasing your risk, right? So that's the only case that you can actually shift your stop loss. So closing of trade position every Friday. So except in exceptional cases where the premise is on the higher time frame bias. So this person is a short-term trader, right? So we have people who trade daily and who trade in the short term. So maybe they trade only, they close their trades every day or they close their trades before the week ends. But sometimes, some of us are swing traders, some of us are swing traders like me. I swing trade sometimes, which is that I hold my position more than 1 week sometimes. So I could, if my tip is still far and the market is going as predicted, I will just leave it overnight, about over the weekend. You guys, it's just that they're going to accumulate something called swap, which is usually going to be negative. So it's going to give us some loss. And then if we open a new week, the market may jump unexpectedly. So that's why it's good to close your trade before the weekend starts. But then if you're in good profits and you have already lost profits, then you can actually leave it over the weekend, because no matter what happens, you'll still be in slight profits. You get. So that's just the thing about it. So after a major win, 10% and above, take a break off trading for that week till the next week. This curbs addiction to trading. Yes, trading can be addictive. Anything you do a lot can be addictive. So everything we should do it in moderation. So if we get a really big win at like 10% and above, we should take a break from the market for 1 week. Or for the rest of that week, the next week, get. Because if we, like most times, after a big win, you usually feel high and mighty. And then you start making trading mistakes that you would normally make. Get. So it's very, very important that you actually take a break sometimes. Because if you do not take that break, you might actually make some trading mistakes as a result of euphoria. You can say, I'm so good. Wow, what a nice trade. Let's do another one. And then you go, you may increase your lot size or you trade without thinking straight. You get. So it's important that you take a break so as to calm yourself down. Okay. So they should be not treated in this environment. High impact speech, FOMC related events, and non-farm payroll. These environments are wild cards and price can do unexpected things. So I said this thing when I was talking about what I do during news event. I said I stay off the market because this is a time when they can easily manipulate it as a result of the news event. I can actually predict its accuracy where price is going to move during news events. Actually, very, very unpredictable. You get, though you can predict the direction the news event is going to go, but you won't be able to give like there's an accuracy that I get with normal markets, and then during news, it may not hit that. It may not hit it perfectly, or it won't go the total wrong way. Yeah, so news can be very, very, very unpredictable. So I usually stay out of those. And you should too. It's just wisdom. So this should be days you strictly do nothing. Exit existing trades and stay out of the market during this event till the event is over. Preserving your capital should be your priority, not profits. Okay. So Mondays and Fridays should be excluded from your trading days. These days should be to boost your trading psychology. Listen to a podcast, watch a video, a book, etc. Except in rare cases where you really must, wait for New York Q-Zone. New York Q-Zone is a term in institutional trading. I want to talk more about that for those in my mentorship. It's not that big a deal, so it's not that important. So you should actually take a break on Monday and Friday. Monday should just be like here before, checking the market directions, trying to find your entries and all that. Why Tuesdays is actually when you enter the trade, and you should be exiting on Thursdays. Yes. So because Tuesdays to Thursdays, between Tuesday and Thursday, those are the most volatile days of the week. You get, these are the most volatile days of the week. So it's better you plan your trades to fit into those. Monday trading sometimes can be good, but most times Monday trading has not always been sweet for me. So you have to jump into the market. Just calm down. Watch the market very well. Let it move. Let flex its muscle a little bit on Monday. Then on Tuesday, you cannot enter and then do your stuff. So if Morgan opens book, it's a CD. Should not trading stuff that I said I'll talk about later. Tuesday should tell there should be a major trading days where you scout for opportunities. Less trading, higher rewards. Yeah. If you're ready, 80-20 rule, you would know more about this thing. So if the market is not one-sided, an obvious high or low to touch and not engage, it must be one-sided at this make it high probability. Consistency is only found in this approach. So we should only treat markets that are one-sided, i.e. we are heading for a particular resistance or a particular support. You get, we're heading for that place. You want to break it, you want to smash it. So if it's not something like that, then it's not a high probability market trade. So wait for such situations where you know that this is purely bullish or this is purely bearish. You get, because those are the places where you can actually make easy money. Easy money. So the market will always remain probabilistic. Therefore, it should be a perception of risk when entering trade traders in a market. All right. So category 2, 9 to 10 figures. Okay. This place there's really not much difference between here and the other one. Just that here we have tighter risk management rules. Yes, our risk management rules is much trickier. You can see that our risk purchase has to be lowered because we are dealing with much larger funds here, $100 million and $1 billion to $1 billion. So we have 0.1 risk, 0.1% risk to 0.5% risk per trade position. Our max loss per day is 1%. Max loss per week is 2.5%. Right? So 0.1% risk on $100 million is going to be about $100,000 out of it. $100,000 risk per trade position. So what else is different here? So if your loss is consecutive for 2 weeks, we should have 5%. Take a week off to reassess the market and come back later. So that is it. That is it. That's all for this material here. I hope you've understood what you are doing with here. I'll end the video here. If you have questions